Risk in business is a vast subject. You can take entire degrees in it. Master's courses in risk management are commonplace, and they come in many flavours. For instance, Leeds University offers a master's in financial risk management. Sussex offers one in banking and risk. Sussex in corporate and financial risk management. Edinburgh one in banking and risk. Glamorgan one in sustainable business risk management. And almost all business schools offer master's degrees in generic risk management. So I wasn't sure exactly what I should talk about. I could have discussed a highly specific aspect, such as some part of my own work in the financial sector, pharmaceutical sector, or as a legal expert witness or something like that. But this is a plenary talk. So I have assumed that most of you won't in fact be specialists. And I always believe it's a bit unfair to impose something too narrow on a general audience. The alternative then is to be general, but to try to find things to say which are at such a high level that they're sort of anodyne and pointlessly superficial. And I've gone for the second of these approaches. You could say that I've taken a risk. So I'm going to kick off by pointing out that risk's got multiple meanings and, in fact, multiple definitions. A common way to think of risk is that it's a combination of two things. It's a combination of the probable frequency of something with the probable magnitude of a future loss. So a combination of frequency and magnitude. Perhaps, for instance, the product of these two things, the product of probability and severity of an event. But of course, risk typically is used to refer only to negative events. We speak of the risk of breaking our leg, but not the risk of winning the lottery. So risk is bad news. Risks are, if you like, to be avoided or minimized. There are exceptions where risk is used in a particular specialized sort of way. Financial risk is a little bit different, for instance, and risk in that sector is often typically the unpredictable variability, the standard deviation or variance or something of financial returns. So it's a characteristic of a probability distribution that we're all familiar with. I'm going to come back to that later. But I think what we must bear in mind in all of this is that risk is just one side of a coin, the other side of which is reward. And these two things are generally complementary. We increase our potential reward at the cost of also increasing our risk and the other way around. And our language is full of aphorisms reflecting that sort of thing. So fortune favours the bold, for instance, and the SAS motto, who dares wins, reflect this sort of balance between risk and reward. We should also bear in mind that the consequence of eliminating a risk is eliminating the complementary potential reward. So I can avoid the risk of my ship sinking entirely if I keep it in port. But if I do that, I won't make any trades, I won't make any money from sending it around the world. So we don't really want to avoid or minimize risk. What we really want to do is to balance that with the reward, its complementary aspect. So in some sense, we want to combine those two things in what I've called here a risk-reward ratio. It might not actually be a ratio, that's just a way of describing it. So some suitable definition of combination of these two complementary aspects. In some areas, that balance is made explicit, in finance, for example, but in other areas, it's often obscured, and the emphasis is on risk minimization, risk avoidance, risk reduction. There are other things we should also bear in mind in this context. The first is that not all risks can be totally eliminated. No matter how healthy a lifestyle I lead, eating certain kinds of things, getting exercise, I can't completely eliminate the chance of getting cancer, the risk of cancer. And of course, risks are often associated with other risks. Reduction of one can mean an increase in the other. So we're all familiar with pharmaceuticals having side effects. They benefit you in one way, but you take complementary other sorts of risks. The second example here is, the government are very keen on promoting people to cycle more, to get more exercise, because that's going to reduce the number of heart attacks. But of course, it's complemented or compensated for by the fact that more cyclists are now going to be killed on the roads of London, for instance. So we have to balance these different risks. This is different from the risk-reward thing, but it's a balance of risks now. And the third thing that I put up here is that risk reduction itself always carries a cost. In order to implement a risk reduction strategy or program, you've got to pay for it. So my examples here are you're going to have to pay for the cycle lanes on London's road, for instance. And there are often hidden costs. Here, my second one, motorists, of course, pay in terms of increased travel time while they're stuck behind cyclists, for instance. But if we can quantify risks, if we can quantify one kind of risk, we can weigh them against other kinds and then also weigh them against the complementary rewards. And we can also insure them. And while I was thinking about what I was going to talk about at this talk, the Lanchester there is to remind me. While I was preparing this talk, I happened to be reading a book by John Lanchester about the financial crisis called Whoops, which I recommend. A footnote in that book, it's about insurance, a footnote in that book comments on the fact that car insurance is more expensive for writers than for the general population. And Lanchester asked a mortgage broker why that was. Is it, said Lanchester, because novelists are supposed to be drunk all the time and prone to crashing into things? The broker replied, yeah, partly, but it's more that you'll write a book and it'll be a big success, like Bridget Jones or something. And then they'll make it into a film, and you'll meet Renée Zellweger. And then you'll be driving around with her, and you'll have an accident, and she'll go through the windscreen of your car. And the insurance company will have to compensate her for her loss of earnings. That's what they're really worried about. But note the danger of disconnecting risk from the cost of covering the risk. The regulatory authorities concerned with controlling risk can't do all they can to minimize it without taking into account that it's going to cost somebody, probably not them, to actually implement any procedures that they introduce. Okay, so where does statistics fit in all of this? Well, the fundamental role of statistics in risk analysis is to model the probabilities associated with it, to quantify or measure the risk, if you like. Now, risk measurement is what I call pragmatic measurement. It's a kind of measurement where you have to define what you're talking about at the same time you say how you're going to measure it. It's different from measuring length or weight, which are sort of pretty explicit mappings from things in the real world to a numerical system. So as far as measurement concerned, as far as risk is concerned, the measurement procedure is the definition. And I've got a little illustration, a little quote here, which illustrates this from Paul Slovik's book on the perception of risk. It's very much like subjective probability. Risk, he says, doesn't exist out there independent of our minds, waiting to be measured. Human beings have invented the concept of risk to help them understand and so on. There's no such thing as real risk or objective risk. So if we've got to think how we're going to define and measure risk, well, there are different ways of measuring it, and different ways of doing that will suit different objectives. You've got to think what problem you're trying to solve is, what the question you're trying to answer is, and on the basis of that, come up with how you're going to define risk. So I've got a couple of examples here. You might measure transport risk in terms of fatalities per journey, or perhaps fatalities per mile, different things for different objectives. Mortality risk might be measured in death per million, or, since this is to do with this talk, is to do with business, death per $1 million of product or something. Different ways for different objectives. Financial markets have come up with lots, people who work in the financial sector have come up with lots of different ways of measuring risk. This is just a graph of a financial time series. It's the S&P 500 over a period of time. But here are some of the different measures of risk that the financial people have come up with to describe the volatility, uncertainty, the risk associated with that. Sharpe ratio, which is like a t-statistic essentially. The Sortino ratio, which is a variant of that, which just looks at the negative aspect, not the symmetrical aspect, like the Sharpe ratio looks at, and many other measures of risk. I'm not going to go through these. Clearly, since there are these different definitions, and since they are different, if you focused on one of them and tried to optimize a system to minimize that risk, for instance, it might have a very different effect on another risk. So it's very important to work out what you're trying to do before you do it. And this applies everywhere, not just in the finance sector. Now, as everybody in this room knows very well, statistical modeling these probabilities, has all sorts of complications and pitfalls. It requires genuine expertise, and I thought I'd illustrate that by just touching on 2 or 3 areas. First, a little bit about model risk, which ties in very nicely to what Anthony was saying, then a little bit more about regulatory risk and so on. So model risk. I'm going to say, well, the financial crash gives me a great sort of opportunity to talk about model risk here. This quote is from Sebastian Malaby's History of Hedge Funds. It's called More Money Than God. He says, he's writing about the year 1987 when there was a crash. He says, an event such as this crash wouldn't be anticipated to occur even if the stock market were to remain open for 20 billion years. Moving on 10 years, writing about 1998, Roger Lowenstein in his History of Long-Term Capital Management, the hedge fund which collapsed in that year, When Genius Failed, that's the title of the book, said the figures implied it would take a so-called 10 sigma event for the firm to lose all its capital in 1 year. 10 standard deviations away from the mean. I'm going to move on another 10 years, roughly to 2007. Bill Bonner, writing in Money Week, things were happening then that were only supposed to happen about once every 100,000 years. At this point, I'd like to move on another 10 years and tell you about the crash that happened in 2017. But you're going to have to wait to find out about that one for yourselves. I'm just going to move on to 2010 to David Gartman in the Gartman letter. What we witnessed yesterday was a series of movements of utterly unprecedented proportions. Actually, it's pretty precedented from what I've just told you. But with currency price changes that are at 6th, 7th, and 8th standard deviation from the norm. Now, all of this makes perfectly good sense to a statistician. It's what Anthony said. If your model is wrong, your probability estimates are wrong. And we're almost by definition in this sort of area talking about the tails of distribution. So we're talking about rare events. And I've put up, this is bread and butter to you guys, I've put up a couple of distributions which look pretty much the same there. One's a normal distribution, one's a Cauchy distribution, and you know that that's going to cause us problems. If you look at the probability, if you look at the probability of being more than 10 standard deviations for a normal distribution, it's 7.6 times 10 to the minus 24. You know, it's not going to happen. Borel's law tells us that the probability that small will never be seen. I've got a book coming out soon which is about Borel's law, so if you don't know Borel's law or believe in it, you know where to look. Borel's law tells us that a probability of 10 to the minus 24 is never going to happen. Cauchy distribution, if you model it with a Cauchy distribution instead of a normal distribution, you've got a 3% probability of getting a deviation that big. 10 to the minus 24 to 0.03, big difference. No wonder we see them. If you go out further to 20 standard deviations, and with a normal distribution, the probability of observing something that big is 2.7 times 10 to the minus 89, a small probability. For a Cauchy distribution, it's 1.6%. So no wonder we're seeing these things if we're modeling it by a normal distribution, but that's inappropriate. It's quite reasonable for a Cauchy distribution. These are sort of artificial examples, but they convey the idea. If your model's wrong, clearly your probability estimates are going to be wrong. So I'm not going to say any more about model risk because it's statisticians' bread and butter. You know about model uncertainty and so on. Let me say a little bit about regulatory risk. I'm going to take an example from retail credit scoring because this is an area I know something about. The aims in this sector are to decide which individual, people, not companies, individuals like ourselves, who should have a loan, a credit card, a mortgage, and so on. And of course, also complementary to that, to facilitate business transactions. The aim is to control the risk that someone you lend the money to or give the financial product to will default, prevent fraud, and so on. Those are sort of the aims. Now, clearly this exercise is fundamentally discriminatory. We're trying to discriminate the good risks from the bad risks. It's discriminatory in the same sense that we give different degree classes to students and so on. Now, clearly we want to do the best we can in discriminating between the good risks and the bad risks, so we want to build the most predictive statistical model we can. Now, how are we going to do that? Well, we'll clearly throw in any variable we think which might add to our predictive power, make it better, and we'll do all we can in terms of building the best models we can. We'll use support vector machines or neural networks or whatever. We'll transform the variables. We'll use generalized linear models. Anything we can, we'll do the best we can. But then we run into a problem because in all Western countries, 90% of the population, 90% they have something equivalent to this. I've taken the US one just because it was most convenient, but because it's got the nicest phrasing. But I could have taken the UK one or anywhere else. The US Equal Credit Opportunity Act of 1974 says it's illegal for creditors to discriminate against any applicant on the basis of race, colour, religion, national origin, sex, marital status, or age. By law, you can't include those in your model. Even if, as is in fact the case, women are less risky than men and older people are less risky than younger people. You can't use sex or age despite that. So it's illegal to treat certain groups differently, even if we know that those different groups have different degrees of risk. So retail credit scorecards, for instance, mustn't include sex. The disadvantages are obvious. They mean that I'm going to focus on the difference between the sexes in this example. Could have done it with any of the other things. The disadvantages are that women have to pay higher interest rates, and have their loan applications, for example, rejected more often than if the decisions had been based on their actual probability of defaulting. So creditors want to use the most accurate models. So if sex is prohibited, they're not allowed to use that. What would they do? What they do is find a proxy variable, hair length or something, I don't know, which can stand in for sex, and include that in the model until the regulators spot what's going on, indirect sex discrimination, and make that a precluded variable as well. So something else is included, and then that's cut out by law and so on, so we have a never-ending series. The trouble is that dropping all of these variables in turn also eliminates the predictive power of the variables, which is uncorrelated with sex. It eliminates permitted power. So what should we do? Well, I'm going to give you 4 possible solutions. The first one is we should treat men and women equally by allocating the same proportion of men to the good class as the proportion of women to the good class. And we're going to do that by building separate models for men and women and choosing the thresholds below which we, or above which we give them the loan and below which we don't. We're going to choose a threshold so that the same proportions are classified as good in the case of both men and women. But of course, since these estimated probability default distributions, score distributions, are different, that means choosing a different probability threshold for the two sexes. So for instance, we'll lend to men if the probability of defaulting is less than 0.8, and we'll lend to women if it's less than 0.7. We're treating the two genders differently here. Building separate models for men and women is equivalent to including sex in your model and all the interactions of sex with the other predictor variables. So you've contravened the Equal Credit Opportunities Act. So we can't do this. Solution B is to treat men and women equally by allocating men and women to the same class when they have the same probability, or to the good class when they have the same probability of being good. I should say good class. And we're going to do that again by building separate models for men and women, and then we're going to choose the same probability threshold. Not to make the same proportions classified to the good class, but choose to classify them to the good class if they've got the same probability, which I'm going to call T. If they've got a probability of defaulting less than T, we're going to classify them to the good class. The trouble with that, of course, is that now, it's the complement of the other example, it means different proportions of men and women will be accepted, will be given the loan. So again, perhaps that contravenes the Equal Credit Opportunities Act. It certainly means, again, because we're building separate models, that sex is implicitly being used as a predictor in your model, sex and its interaction with all the other variables. So again, we can't do that. Solution C, well, we want to build the most predictive model we can, but one which doesn't let sex contribute to the classification. So what we're going to try to do is eliminate it statistically. So for instance, in the case of a linear model, what we could do, a simple regression model or something like that, we could build a predictive model using all the variables we can get hold of, including sex and any proxies for sex we can think of. But then when we come to make the prediction, we don't include sex. So basically, how we describe regression when we talk to students, we're controlling for or adjusting for sex. And you can do something similar with nonlinear models where you work with the residuals of all the other predictors in a regression on sex and then use that as your default probability. We can do the same for nonlinear models. But again, this possibly contravenes the Equal Credit Opportunity Act because, again, it uses sex in building the model. Personally, I think this is the right way to go, but it's a bit complicated to explain to the authorities who haven't really seen what I'm getting at yet. Solution D is what is in fact done now, the current solution. Simply prohibit sex and the proxies from being included, that sequence of variables which are eliminated. But that means that people aren't being assigned to the risk category using the best risk estimates for them, with the problems that I mentioned earlier on. It overestimates the risk for females, underestimates the risk for males. So in a sense, it meets the letter of the Equal Credit Opportunities Act, but it certainly doesn't do what the Act was supposed to do. It contravenes the spirit. Now, that's a punchline, so I don't want you to see that. Now, I used to be terribly envious of the insurance industry, which was allowed by law to discriminate between males and females, with the best probability estimate it could for females and the best probability estimate, different one perhaps, for men, and decide to charge people for insurance on the basis of the probability that they would have an accident or whatever it was. I was terribly envious of that, and I assumed that at some point that the credit scoring regulators would move in that direction, because clearly it's the right thing to do. So I was a bit disappointed last year when the European Court of Justice ruled that it was unlawful sex discrimination for insurers to distinguish between men and women when deciding their premiums, and move the insurance industry over towards the credit scoring industry, which I think's got it wrong. Punchline always here, despite the fact that, for example, women are safer drivers than men. Just three sort of contextual points here. People, of course, should be treated as individuals rather than stereotyped, but that's a problem for us as statisticians because probability, one way or another, probability estimates have to be based on aggregates, and we can talk about that in more detail. Second, modern society is uneasy about letting some characteristics be used, even if they are predictive. So thinking of my loans example, suppose it was found when building a model that different racial groups had different probabilities of defaulting. We'd be very uneasy about including that. And thirdly, it's intrinsic to what one might call a civilized society. In some sense, this might be a definition of a civilized society, that some risks subsidize others, that we look after the less able or whatever. And my example here is no-fault risks, inherited diseases, and the NHS, for instance. Now, this in fact goes further and drifts into this, the next section of this talk, which is the law of unintended consequences. Suppose we try to tackle this problem by equalizing, and I'll switch over to driving from driving insurance from credit scoring. We try to equalize driving insurance costs at some sort of suitably weighted mean of current male and female charges, the values. One of the consequences of that is that the higher risks, who previously couldn't afford insurance, now will be able to. If you had tried to insure them at the value which would have been appropriate for their risk, they couldn't have afforded it. But now you're going to charge them at this lower mean value. Now they're encouraged to buy insurance and drive on the roads. That's great. Now we've got these higher risk individuals who are more likely to crash driving on our roads. They've been encouraged to by this policy. That's not very good for the rest of us. But on the other hand, maybe they would have been tempted to drive without insurance. So, maybe it would be beneficial. At least they are now buying insurance. So when they crash, these high-risk people, they're insured. That may or may not compensate for the fact that the lower risks, the women, I suppose, who previously would have been charged at an appropriate low rate, given their risk, are now being charged at a higher rate, the average rate of the two previous values. So now they're having to pay more, and perhaps some of them will decide to drive without buying insurance. So there are all sorts of complications arising from this. Another example of the law of unintended consequences in this law, of course, appears all over the place and causes all sorts of complications and subtleties. And I think it's quite clear from my credit scoring and insurance example that the law finds it difficult, the legal law finds it difficult to cope with. The example I want to give here is crime maps. These were originally trialled in Chicago. you'll be familiar with them, I'm sure. They're regularly updated maps showing the location and dates of crimes. They exist in the UK now. From the police perspective, they're great. They enable better decisions, better targeting of resources, and improved tactics. Public's perspective, they're great. You can identify risky areas to avoid and demand more police action if that's an appropriate thing, so on. So great, we've got a lot going for them. But the law of unintended consequences. There was a survey carried out by an insurance company, Direct Line Insurance. They found that 11% of respondents who claimed to have seen but not reported an incident. Why? Because they were scared it would drive away potential purchasers of their house or renters of their house. So there are complicated feedback, unintended consequences coming in here. The crime maps were great, but now the quality of the data could be going through the floor. Another little example of this is moral hazard. This is the case where some sort of, well, the classic example is too big to fail. Someone's insured and says, right, you know, if I have an accident, it doesn't matter, so they act in a much more risky way. That's related to the notion of risk compensation and risk homeostasis, which says that people basically have a level of risk at which they're happy to live at. And if systems are put in place to make things less dangerous, people behave in a more risky way. One of the classic examples of this was a discussion, a debate at the time seatbelt legislation was introduced. The fear was that putting seatbelts in cars would make people feel safer and therefore drive more dangerously. Of course, putting seatbelts in cars make people alert to the risk and therefore drive more safely. But at the time of this legislation, an alternative suggestion to seatbelts was proposed. This was that instead of having seatbelts, which make you safer in a crash, all cars should be fitted with a steel spike on the steering column, poked at your chest. Then you'd drive carefully. Drivers and cyclists drivers versus cyclists is another example of this. Studies have shown that cyclists have the type of cyclists who have fewer accidents are those who appear to be cycling very unsafely. So if you wobble all over the road, motorists steer well round away from you. So there's something to bear it. That's the message to take away from this talk. Just a couple of slides on controlling risk, because this is another role of statistics based on the modelling of probability. What we've got to bear in mind is that we do our statistical modelling to model probability, that our statistical models are only one component of a system, which is a human system at some sort of level. An effective control requires looking at the whole system. And I think one of the nicest sort of areas that I've seen these things in this sort of perspective taken is what are called confidential information incident reporting systems. And the example I'm going to give is the NASA aviation safety reporting system. You may not be able to read that. Basically, what happens is in the aviation industry is that if people have pilots or flight attendants, whatever, have accidents, mechanics, they are encouraged to report what's happened, and it goes onto a database and it's completely anonymized. So you don't get penalized for putting it on there. It doesn't sort of go on your record in some sense. And there are over 1 million on this database now. And as a consequence, well, the aviation industry is in fact one of the safest industries around. And I was involved in a project with the National Patient Safety Agency, which is a part of the NHS to do with incidents in hospitals, which was trying to introduce a similar sort of system to this, a confidential reporting system, so that you can own up to an accident and you won't be penalised for it, but it will go in to improve the general strategy. So that's where I'm going to finish, just to say risk comes in many shapes and forms. Statisticians obviously have a central role in modelling it and in controlling it. Competent statisticians avoid the hubris of assuming that their models are correct. It's not normally distributed. The normal distribution doesn't really exist in real life, of course. It's a mathematical, it's like a point or a line in geometry, a mathematical idealization. And the final point, the importance of looking at the bigger picture. Thank you very much.